The big story this evening on the show is markets and global markets. Of course, the US inflation numbers coming in at a 39-year high at 6.8%. Surprisingly, though, it's not all bad news for Wall Street, which has opened up in the green because even worse was expected. The inflation numbers are actually in line with what was broadly expected. So just to give you a quick look at how US markets have opened, Dow Jones is up about 142 points, about 0.5% up in the green. The Nasdaq up nearly a percentage point up, and S&P 500 as well up in the green this morning. So why exactly are US markets rallying? That recovery is being seen. That's something we're going to talk about ahead in the show. Just to give you a quick check on what happened in Dalal Street, volatility has been the name of the game, and a tricky week really that has closed today on Dalal Street. The Nifty, however, managed to clock in gains for a second straight week. The Bank Nifty too saw a drubbing earlier, has recovered this week after underperforming for 6 weeks at a stretch. All right, just let's take a look at US consumer price numbers, which are up 6.8% year on year and 0.8% month on month. So inflation is sticky. Inflation is continuing to hurt. Peter Cardillo, Chief Market Economist at Spartans Capital, joins us now for more. Peter, great to have you on ET now. Hope you're doing fine. Tell us about the inflation numbers and why it's not looking so scary to Wall Street.
Well, to begin with, I think they're already priced in. Everyone was expecting for high numbers, and we got high numbers. In fact, they were a little bit higher than I was looking for. Obviously, year over year, 6.8% versus 6.7% is indicative to the fact that inflation continued to grow basically on a monthly basis. Core rate high. But, I think what the market is looking at is the fact that a lot of this inflation is due to the pandemic and, of course, to the supply chain bottlenecks. And so that's causing inflation. And from that perspective, the market is looking forward and saying, well, maybe within the next 2 months or 3 months, the chain supply situation will lessen, and that should mean some of this inflation will be coming down. And I think that's why the market is reacting the way it is. In fact, if you look at the bond market, you'll see that before the news was released, the yields were higher. The 10-year was trading above 150, close to 151, 151.5, and now it's back under 150 at 147.90. So again, a lot of this was anticipated, and that's why the market is reacting the way it is.
What about looking at Fed's taper schedule? Is that also something which is being factored in now, Peter? What would really shake that boat?
Well, to begin with, next week we should be getting an announcement that the Fed is going to accelerate tapering, and we're probably going to get hints that monetary policy here in the States is going to change a lot sooner than the markets are expecting. And I think, by the way, that's also priced in. So I think, we can get hints that maybe in the middle of the second quarter of 2022, we can see a rate hike of 25 basis point, and that could be followed by another rate hike at the beginning of the summer, the third quarter of 2022. So I think that just means a more hawkish Fed going forward. Certainly a more hawkish Fed than we got from the previous month.
Okay, thank you so much for that, Peter Cardillo, coming in and filling us in with some context on what we're seeing on Wall Street this morning. Inflation numbers sticky. Inflation number high, highest in 39 years, but on expected lines. That has been priced into the market. So you're seeing US markets holding firm in opening trade this Friday morning, their time.